Chuck Carnival, and I'm the Chuck in the Markets Up, Chuck. And, we're entering earnings season now. There's going to be a lot of talk about different companies, and they're going to be reporting their earnings. There's going to be a lot of market volatility and reactions to that. And there's also going to be a lot of talk about the market in general, whether the market's going to continue to rise or not. And, the thing that we keep trying to point out in this blog is that it's offered to provide insights into investing in good businesses rather than the stock market. We view the stock market as merely the place you shop at. So I'm going to use 4 examples today just to illustrate how different individual companies are. And our goal here at the Markets Upcheck is to appeal to the long-term shareholder-oriented investor and not the day trader. So I'm going to use 13-year charts. I'm going to start with Cognizant Technologies. Here's a company with no debt on the balance sheet. I want you to notice their earnings record has been spectacular since 1998. They've averaged over 49.2% growth. And even with the price being very weak as a result of the recession, notwithstanding the fact that earnings continue to grow, even though there has been some recovery on top of that, you have a 49% earnings growth rate, and shareholders in this company, if they put $100,000 in 1998, it would be worth $7.7 million. That's a 47% compounded rate of return. And by the way, the S&P 500 has actually lost money during that same period, or compounded at a minus 0.05%, or lost 0.5% a year compounded. So here's one example of a company that basically generated its returns based on the strength of its business. Now, my second example is American Electric Power, a utility stock. And what I want you to notice here is that over the same 13-year period, there's literally been no earnings growth at all. If nothing, earnings have maybe decreased a little bit. I want you to notice there's been a lot of volatility in the stock price. They do pay a decent dividend and currently have a nice dividend yield. But shareholders of this company bought and held, for the last 13 years, $100,000 would have actually shrunk to under $60,000, and this is a slightly different time frame here than the other, but it's very close. We're only a few months. The market would have averaged about 0.8% or just less than 1% a year, and this company would have lost 4.3% a year compounded. So a stark contrast here, 2 examples in the same stock market, the same story, if you will, 2 entirely different companies. So my next example here is Church & Dwight, and it's really a poster child for earnings determined market. But I want you to notice how consistent the earnings have been, the green line. The black line are the monthly closing stock prices during this 13-year period. The company's grown earnings at 18.5%, and notice how the stock price is correlated with that. Shareholders in Church & Dwight would have averaged just under 17% a year, which indicates slightly low valuation, again, during a period where the market did, less than 1% a year. So $100,000 here turned into $600 versus $100 in the market, round numbers. The point is, it is a market of stocks, not a stock market. So my contrast to Church & Dwight would be WD-40. They're both in the consumer products sector. Here's another company with a nice dividend yield, but again, very erratic earnings, almost no growth, about 1.8% growth. A lot of price volatility in the middle from year to year. But the point I want to make is shareholders in this company averaged about 1% a year. They did almost exactly what the market did because there's been no earnings growth in this company. And in the long run, it's the business that generates the return. In the short run, you're always going to have this stock price volatility. But the final point I want to make here is that this is a market of stocks, not a stock market. To think in terms of the general stock market, I've always, just never really understood that. We ought to be looking at the individual companies, and that's really the purpose of this blog, is to show you how different companies can be and to try to give you a more learned perspective than either just thinking in generalities or the vagaries of what is often, promulgated by, mainstream media. There's a whole lot of different choices and different opportunities you can make as investors, but ultimately it comes down to the business. And, our approach is business perspective investing. We don't recommend stocks here. We simply show you fundamentals and how the companies have reacted to fundamentals, and you can then do your own research from there. But the point that we really are trying to make here is that it is a market of stocks, not a stock market. I hope this gave you some extra insight. It's Chuck Carnival saying thanks for listening. We'll be featuring companies probably for the rest of the week as it is earnings season, and but I did want to start the week by showing this the importance of what long-term earnings growth really means to shareholders. Thanks for listening.